Thank you for joining us today. My name is Matt Hilland. I'm a financial planner here at Arnold Remote Wealth Management. And the topic of our webinar this month is just where to keep cash today. For those longtime listeners here, you might recognize that this is an update to a webinar we had originally done in 2021 after there was a really big increase in the amount of cash that people were keeping. And at that time, the topic was how to get any kind of return on your cash. Interest rates were just about zero everywhere. And so we did this webinar on just places to be able to get some kind of return. Today, the story is very different. So we're back up to near all-time highs in the cash that people have available. But what's very different than a few years ago is that interest rates have increased, and there are very good ways to actually get some real interest on your savings. And, just to look at what's out there nationally, this is a screenshot from the FDIC's website. They update this data every month, but it does not change very much at all. And what we see when we see this is that a lot of people are getting very close to zero on their cash, right? On savings accounts, checking accounts, you're under a 0.5% very easily. Money market accounts, just over a 0.5%. Uh, and as we'll look here in a sec, it's very easy to get something like 4% on cash equivalents today. That when we start talking about the amount of money that people have in cash out there, there's some real potential here to, get some benefit in looking at the options that are out there and moving some cash around. But there's a lot of options to go through, right? And so I'm listing here a few things that we'll talk through in this webinar, and finding the best option for your cash is not exactly an easy answer because there's lots of things to consider. There are some things that you might weigh a little heavier than others. For example, are you most worried about some kind of government guarantee on your cash, right? I think this is a very valid concern here. You're keeping that cash there to be safe. You want to make sure it's not at risk. And so, if that's the case for you, you might want to make sure you're in some kind of investment that has a government guarantee, right? A savings account that has FDIC protection or treasury bills. You might not be so worried about finding that absolute best interest rate. You just want to make sure there's a government guarantee. So we'll go through how these different options have different levels of guarantee out there. Likewise, if you are at a very high federal or state tax rate, you might have a question about what's the tax treatment. If you have a lot of cash that's kicking out a lot of interest, you should be aware of how different options for cash are taxed out there. And so, for example, things like those high yield savings accounts, money markets that are out there can have very high interest rates, but you're going to be subject to more tax than if you were in treasury bills or municipal bonds or something like that. And so this is another consideration. We'll walk through some specifics here in a sec, but you should just know that all these options have a little bit different pros and cons that you should be aware of, and we'll cover here in a sec. So just to dive into it, I think one of the most popular, one of the easiest options out there for your cash is just to use a savings account at a bank. And these are really great for just that, 1 month of emergency funds, something like that. These are liquid. You can get your money out in a day. You have the FDIC insurance, so you have that US government guarantee. The problem is that especially if you're using your local bank, it's hard to get a really competitive interest rate. Some of those online banks are where you have to go to get the highest rates, and some people might not want to um, move money between banks all the time just to ensure they're getting the highest rate. And as we'll look at in a sec, that interest rate can change. If interest rates fall, the interest rates on your high yield savings accounts are going to very dramatically fall also. And so again, these are great for money that you need access to immediately. But if this is long-term money, if it's money that's going to sit there for years, or you're in a very high tax rate, you should be aware that there might be better options out there. And so just to look at that potential of interest rates falling here, I looked back at in 2019, interest rates had started to tick up from that 0% that they sat at for a long, long time. And here's a screenshot of what users of Marcus Bank, saw. They were getting 2.25% at the time. This was great, right? Uh, about the highest you could get on a high yield savings account. The problem was, though, that a couple of years later, a lot happened between 2019 and 2021, right? And interest rates dramatically fell again. And now that money that you had in the Marcus savings account that was yielding 2.25 a couple of years ago was now much closer to zero. And this is a risk that you take with that high yield savings. If you're using that for long-term money, um, you have to be comfortable knowing that that interest rate can fall at any time. And that's where things like CDs are another very popular savings or investment that allow you to kind of lock in interest rates, right? If you buy a 1 year CD, you're guaranteed a certain interest rate for a year, no matter what interest rates do. And so that makes CDs very popular for longer term savings. If you know that money can be locked up for a year, CDs are a great way just to guarantee a certain interest rate. And of course, you're also getting that FDIC or that US government guarantee as well. But starting to get some trade-offs here. Liquid, there's usually some kind of penalties for breaking CDs early, of course. And especially if you go to a bank, you should know that how banks like to get money is offering specials, CD specials, high interest rates for 6 months. And then they're going to renew at low rates. And so if you aren't paying attention, all of a sudden you're going to find yourself in a CD at 0.5% interest. And again, if you're not paying attention, you're going to see low interest on your savings again. And so uh, again, CDs tend to be much better if there's a specific time that if you can be comfortable locking that money up over a period of time. CDs tend to make more sense than something like a high yield savings account. But again, need to know those liquidity considerations and those tax considerations as well. Um, so, how we can help with your cash savings if CDs are a good option for you. Um, there's certainly better ways to get interest rates higher than that national average. So from that FDIC website, these were the numbers that were there for 1 year or 3 year CDs. So right now you're looking at call it 1.5% about for CD. There are a lot better options. And so on the left here, I'm showing just something that we send out regularly on our newsletter or to clients. And this is just like CD rate survey. So we can look at banks near you, what they're offering for interest rates on their CDs, maybe some specials that are out there, and help you identify maybe the best place to go. By and large, what seems to be the easiest option is what's called brokered CDs. And so on the right here, I'm showing you what we see when we go into Schwab and buy CDs for clients. Brokered CDs allow us to look all across the country, so you can see many different banks here and very quickly find banks that are offering the highest interest rate, finding maturity date that works for you specifically, and really finding that best option for you. And so just know that if you have questions about this, we can help, very well. I think we can find that higher interest rate for you if that's what you're worried about maximizing, help you spread money around various banks if you're worried about the FDIC limit. Just know we're here to help with this. Money market accounts are another really popular savings place because of their liquidity. Again, you can get money out in a day or so from these money market accounts. They have very competitive interest rates generally, and they have lots of good options for if you're starting to look at the tax efficiency options here. You can get municipal types of money markets. You can get government money markets that aren't taxed at state level. Uh, if taxes are a consideration, money markets have a lot of flexibility here. Um, you should know, though, that money markets are not all created equal, and especially at a lot of banks, we see them advertising money markets that have very, very low interest rates. And so, be sure to kind of do your due diligence and check around what's available, because you know, banks tend to not be the best option here from our experience. And know that you may be giving up FDIC insurance for money markets. Again, there's various types here. There are money markets that invest only in government investments, but for some money markets, there is no government guarantee. So you have to be comfortable getting outside of that. And again, just to show you what value there is in taking a look, spending a little time finding the higher interest rates out there. Uh, According to the FDIC, the national average for money markets today is about 0.59%. And then here on the right, I showed some options that would be available to purchase in your, Schwab brokerage accounts or Schwab IRA. Rates for different money market funds. And so again, there's lots of different options when you get into money market funds. You can be government only, you can be prime, which means like corporate or company short-term bonds. You can get municipal bonds, so these are tax-free types of investments. A lot of great options, and pretty much regardless of what you pick, you can start getting well above that national average. So if you're sitting on a lot of cash, this could be a good way to get a good kind of added return on your cash there. Another option that's becoming more and more popular is treasury bills. And so this can be individual bills, or it can also be ETFs or mutual funds that invest in treasury bills. The big benefit here is that you're getting a guarantee by the US government, and this is a guarantee that can be in excess of FDIC limits. And so if you have $1 million in cash out there that you want guaranteed by the government. It would be a hassle, I guess, to spread that around in various banks. The easy way would be to buy treasury bills and have that guarantee, US government guarantee on your savings. As you can see here, interest rates right now are very, very good on treasuries. So short-term treasuries all over 4%, which makes them a very good option, if you're sitting at that 0.5% in your savings account. You have to be comfortable with, though, a little bit of volatility here, especially if you're using those ETFs and mutual funds. They're not pegged, or the value is going to slightly change. It's not drastic. 2022, which was kind of the biggest volatility we've seen in these types of funds, you saw maybe 0.25% of decline in some of the short-term treasury bill funds, but you should know that you'll see that value be a little volatile. And if you want to use individual bonds, it it can be an administrative burden there, right? Constantly buying new bills as old ones mature. I think there's a lot of advantages now to some of those ETFs and mutual funds that are out there. Um, that kind of do that management for you and kind of just recycle those bonds as they mature. And then, one for some people, one big benefit is the tax treatment. So interest on treasuries is not taxed at the state level. And so maybe not a big deal at all if you're in Florida or Texas. If you are in California or Minnesota, this can be a really big deal. Not paying state taxes on interest for this can be a real benefit. I bonds are another thing that are very similar in a sense to treasury bills. They're US savings bonds guaranteed by the federal government, but they have a couple kind of unique characteristics uh, that made it so we want to make sure we bring them up here. These were really popular a few years ago because they provide a guarantee to at least match inflation. And so you put your money into I bonds, guaranteed by the government. Every 6 months, that interest rate adjusts to match with inflation. And unlike CDs, unlike savings accounts, I bonds are really the only way to get that inflation guarantee on your savings. There's also a really nice benefit for some in that the interest is deferred on these. So, CDs might pay interest every month, treasury bills might pay every quarter or semi-annually. You get that interest and are taxed on that interest no matter what. With I bonds, you have the ability to defer interest. So that might be really valuable for those that have really high income. Maybe you're at the end of your career, or maybe you're doing Roth conversions, and every bit of interest that you can defer is going to be valuable. And then maybe for younger families, these they have a really nice feature in that the interest for I bonds can be, it's always tax-free at the state level. It can be tax-free at the federal level if it's used for certain qualified education costs. And so these are sometimes used for younger families saving for their kids, college savings, for example. Um, but a few things to be aware of. The big one here is that you have to hold these I bonds for at least a year. And so you have to be comfortable locking your money up for at least 12 months. And then, the other thing is that you are limited to $10,000 per year in purchases per person. And so, depending how much money you like to keep as cash, I bonds can rarely be your end all be all for your cash holdings, right? You're limited in what you can buy. And so, for most people, I bonds is kind of a part of their cash management, but not the whole thing. And so, what you need to know about I bonds is that when you buy them, there's a fixed rate. And so, that fixed rate is an interest rate that you get for the life of the bond. As long as you hold it, if you buy I bond today, you're going to get 1.1% per year. And then there's a variable rate also that changes every 6 months. And so that's made these very attractive investments at certain times. And so, for example, in 2022, these were very, very popular because, again, that inflation guarantee meant that these had something like a 9.6% interest rate. But the fixed rate at the time in 2022 was 0%. And so, a lot of people went into these bonds, and now as as inflation's come down, the interest rate on these has come down, and that 0% fixed rate that these had in 2022 is with you for the life of the bond. And again, if we look at the I bonds that are available today, you can get a 1.1% fixed interest rate. And so if you are like many others out there that bought these savings bonds, you have a decision today that you should know about. You have the option to sell those bonds that you bought a few years ago that have that 0% fixed rate and exchange them out for new savings bonds that have a fixed rate. Um, but in order to do that, you're going to need to pay taxes on the interest. You're going to need to pay a small penalty for selling savings bonds in less than 5 years. And so there is some math, if you want to see it here in knowing whether or not this decision is right for you. And ultimately, it just ends up being if you think these I bonds are something you want to hold for the long term, there is some kind of break even here. And so I run through an example here. If in May of 2022 you bought $10,000 of these I bonds, today you're going to log in and see that they're worth $11,552. If you sell those today, you're going to pay taxes. You're going to pay taxes on that interest there. So again, this number will vary depending on your tax situation, but let's say you're in the 22% tax bracket, you're going to pay $341 in federal taxes. Once you sell that, you're going to pay a small interest penalty. And, ultimately in this example, let's just say you are going to have to pay $413 in taxes and penalties to sell that bond. In exchange, though, you can buy a higher yielding bond with that, with the proceeds there. And, today make an extra $110 per year. And you can see there is a break even here. So call it about 4 years or so, that if you knew you were going to hold these I bonds for 4 years or more, it makes sense to do the switch. You can also see it's a relatively small amount of money in the grand scheme of things. It is perfectly reasonable just to keep the high bonds that you have. They are going to do their job of giving you a decent return on your savings. But just want you to know if you really like the idea of kind of optimizing your cash out here, there is a decision that you have to make. And if you want to hold these for the long term, it might make sense to start trading out your old I bonds in with new ones. And so, of course, we're happy to help. I know we walked a lot of you through buying these on Treasury Direct. We're more than happy to help you walk through selling and exchanging into newer high yielding bonds if you'd like. The biggest kind of takeaway here is that uh, if you have a lot of cash sitting there earning not very much, inflation is kind of the quiet enemy for most retirees. And even very modest inflation is going to take a significant chunk out of the purchasing power of your savings over long periods of time. And so over a 20-year period, even if we only have 2% inflation, which would be, kind of lower than normal, you're still going to see the purchasing power of your cash savings drop by about a third. If we get into higher inflation again over longer periods, it's dramatic. You're seeing more than half of the purchasing power of your money being eroded. And it's very easy for, I think we find retirees in particular, to build up that big cash portion, as you enter in retirement. But you should really be aware here that inflation is really your number one enemy. And, getting that cash out of the bank savings account, out of those really low interest types of investments is really important in the long run. And if you are one of those people that really want to optimize and get the final dollar, every dollar you can out of your cash, I wanted to run through an exercise here that you'll have to go through yourself, or again, we're happy to help go through with you. But there's something called a tax equivalent yield that is effectively kind of calculating your net return after taxes. And because all these different options have different tax treatments, this is how you can find really the best option for you today. And so, just for example, if you are looking today, you might see that money markets have a little bit higher interest rate than treasury bills or municipal money market funds. But that is not necessarily, this does not mean that money markets are the best option for you, because ultimately you're going to have to pay taxes on this interest that you earn. And so here I did an example for someone with 100,000 in cash in the 22% federal tax bracket in and to start here in a relatively low tax state. So you're in Iowa with the flat 3.8% tax rate. And then here, so not only do you get that interest, but there's certain taxes that you're going to have to pay also, and you're left with some kind of net return. And so I just wanted to show an example here that don't necessarily just choose the option that has the highest interest rate, because taxes play a big part in just about everyone's finances here. And even something that has a lower interest rate might be the better option for you. And then likewise, a lot of people are attracted to those municipal types of investments because they are tax-free at the federal level, potentially tax-free at the state level. And but you have to be at a high enough tax rate for that to make sense. And so here you can see again this hypothetical, kind of household here. Uh, you might be really attracted to the idea of not paying taxes, but it's not worth it in the end. Even though you're paying taxes on some of these higher interest options, it ends up being well worth it for you. But you just want to rerun these numbers depending on your situation. And so if you're in a very high federal tax bracket, subject to certain surcharges in a high tax state, these numbers look very, very different. And what option is best for you just might depend on your state, on your income, on your tax situation. And then finally, I'll say these numbers change all the time. And so right now, quite honestly, it's very tough to beat treasury bills, but that was a different story, 5 years ago when money markets or municipal bonds had a little bit higher rate. And so this is something that you'll want to look at what the interest rates are today, what your tax situation is, to be able to find really that best option for you. And so, kind of in summary here, if there's a few takeaways, I would say one, the best options for cash are always changing. And so you either have to decide if you're going to optimize for this to, spend some time doing that, or I think there's a lot to say about the simplicity of just keeping your cash in something like a brokerage account. So if it's at Schwab, we can change between brokered CDs, money market funds, treasury bills at just about any time. And I think, there's some value in having some flexibility there rather than having to run around to banks and move money from one bank to another as every time your CD matures. Um, right now, having cash in a brokerage account makes it very, very easy to ensure that you're getting a really good return on your cash. For some people, there are some tax considerations here. And so if you're at very high income, maybe the end of your career, if you're doing Roth conversions and in kind of a sensitive tax situation, it might be worth looking at yeah, how the interest on your the interest on your savings is being taxed. And then finally, I would just, kind of ask yourself why you hold cash. For a lot of people, that's your safety net, right? You're not so worried about maximizing the dollar amount, but you want that government guarantee. And if that's you, just be aware that there are a lot of alternatives out there that are being marketed, a lot of, quite honestly, kind of predatory uh, types of accounts um, and investments that are being sold as alternatives to cash that are risky, right? There's been a lot of things lately and some of these high yield alternatives kind of not working or people losing money in them that you really don't want to have happen for that cash that you have. And so hopefully that's helpful. Just a quick run through of the options that you have available. Of course, we're here to help. If you have any questions, let us know. We're here for a little bit to take your questions. Give us a call, send us an email if you'd like. And if there are no other questions, we'll just say thanks again. Have a great weekend and take care.